So let me take you back a little bit. Let me take you in the time machine a little bit to when I got in the market. I got in the market, end of '08 into 2009, started kind of exploring the market. And if we go back to that time when I first got in the market, these were the biggest market cap companies in the world. There was no such thing as trillion-dollar companies or anything like that in those days, and especially because we were in a stock market crash. It was during the great financial crisis, right? But when you looked at all those companies, they all had one thing in common. And that one continuous thing they all had in common were they were needs-based businesses. ExxonMobil, oil and gas, needs. Walmart, needs. Procter & Gamble, you're talking about paper towels and toilet paper and tissues, things like that, needs. Microsoft, need. Johnson & Johnson, need. Berkshire Hathaway, they own so many different businesses across the board, and back then they did as well, not nearly as many as they do today, but all needs. Chevron needs, oil and gas, right? AT&T needs-based business. General Electric, JP Morgan, Pfizer, IBM, Coca-Cola, all needs-based businesses. None of these companies represented excitement, hope for the future, huge innovation, huge growth, or anything like that. Now, if I fast forward just a few years, we have a startling change that happened, okay? And this is where the story really begins. Check this out. So by 2011, now there were 3 companies that were among the biggest market cap companies in the world that really represented technology and innovation. And those companies were Apple, Google McDougal, and Oracle. These companies really represented the cutting edge of technology, innovation, hope, exciting new revenue opportunities, not just for themselves, but for other businesses with app stores and different services and things like that. Such an exciting time. Then if we fast forward to 2018, by that point in time, the top 5 market caps, the top 5 biggest all represented tech. They all represented innovation. So what a takeover in a matter of, we can call it about a decade or less than a decade, where you went from all the companies that were the biggest market caps were needs-based companies that were just kind of sleepy, to by 2018, it was all the biggest market caps were more tech-related, more innovation-related, right? Now, if we look at today, right, and we think about Apple's been one of the big dogs that has gotten the stock market to where it is, right? There's been a big fundamental change which has happened in many of these companies, like in Apple, for instance, right? Apple no longer represents what it used to represent. It used to represent growth. It used to represent tech, innovation, those sorts of things. And unfortunately, Apple doesn't represent that. And you can really see it in its numbers over the past few years. Tech companies, innovative companies, they don't have situations where their revenue is going negative on a year-over-year basis. They don't have situations where their revenue is stalling out. That's not innovation companies. That's not tech companies, right? That is more of a telltale sign of an oil and gas company. Let's call it a company that is more of a needs-based company, not an innovator at the end of the day, right? If we think about, I posted this up earlier this week, is something I saw that was great out there, Johnny Ive, in his contributions to Apple. He's a man behind AirPods, Apple Watch, iPad, MacBook, iPhone, iPod mini, iPod, the iMac. The man completely transformed Apple for the better forever, and he put the whole company in this place that it's at today, right? And this was the Apple that Johnny Ive and Steve Jobs built. But it's very different now, right? And if you look at a company like Apple, it's embarrassing. You could never even conceive of stuff like this happening in the past, right? Vision Pros are being returned because a headset, people don't know how to set it up. That's crazy. Like Apple, this would have never happened in the past. This is ridiculous. This shouldn't even be an issue, right? 1 month with Apple Vision Pro in the air, on a train, and in a drawer. Up to 30% of Apple Vision Pro returns are because users don't get it, right? Could you ever imagine Steve Jobs launching a product that had a ton of people returning it and saying, I don't get it, it doesn't make sense, I don't understand it, I don't know how to set it up like that? No, that would have been ridiculous. Steve Jobs never would have done that. The magic with Steve Jobs and Apple products was, from before you even got the product, you understood why you wanted it. I need that, I want that, I can't wait to get that. And then once you actually experienced it, it even made you more excited of wow, this is transformative for its day in age it was in. And you look at something like a Vision Pro, and it's flat out embarrassing kind of what's going on, right? So Apple has become a Walmart. Apple's become an ExxonMobil. Apple's become a Chevron now at this point in time, which completely changes up the fabric of how you need to judge the stock market, where you need to see opportunities. Understanding a company like Apple is now these sort of companies, right? So the same thing is, not to just pick on Apple, but it's happened with Google McDougal as well. Google McDougal used to be the company of tech, innovation, of big things happening. But even Google McDougal, the $1.7 trillion market cap, they're in the same exact boat as Apple now at this point in time. Two of the big two companies that gave us so much hope over the past 15 years have become oil and gas stocks. Think about it this way, right? I think there's a potential of a next iPhone super cycle next year, because they're going to come out with bigger iPhones. Usually when bigger iPhones come out, they have a super cycle. But such sad, pathetic part of that is, if Apple has a super cycle of iPhones, it's no different than looking at an oil and gas stock and hoping that oil price is going to go up a bunch in the short term. So, the profitability of ExxonMobil and Chevron will shoot up massively for a year or two, right? It's the same exact situation with Apple. So the way you used to view an ExxonMobil or Chevron is the exact same thing you view an Apple now. Oh, somebody's iPhone breaks, they got to go get another iPhone because they're locked into the ecosystem. Somebody's MacBook breaks, they got to go get another MacBook or iPad because they're locked in the ecosystem. It's a very different thought process than traditionally with Apple 10 years ago, 5 years ago, 15 years ago, 20 years ago, right? Very, very large change. And like I said, it's not just Apple, it's Google as well. They're both the same exact situation. You look at Google, it's like, Google search is like, it has to be there. You kind of have to use it, no different than you have to use oil and gas, right? And if you look at YouTube, it's a must use. And so it doesn't mean these are bad companies, but you got to understand there's a very different way of viewing these companies now. And so you've got to view them in a line light, very similar to how you used to judge oil and gas stocks. And oil and gas stocks also usually trade at much lower P ratios and those sorts of things. So that is something to keep in mind as well. Now, we also have companies on the fringe of going over to that Apple and Google side of kind of being viewed as oil and gas stocks. Not quite there with these two big dogs, but I will say they're kind of close, okay? Microsoft, and including one of my investments personally, Amazon. Amazon's one of the biggest positions I have in the public count. The only thing that's keeping those companies from going into that Apple and Google category with oil and gas stocks, I call it, is Microsoft has, obviously invested so heavily in OpenAI. So that gives them that kind of super innovation there to kind of keep them away from being looked at as an oil and gas stock. And then Amazon with AWS and some of the innovation that's happened there, that's kind of kept them out of getting into that Apple and Google category of being viewed like, needs-based companies, and that's all they have to offer, right? So, excuse me, who are the real big tech innovation companies now, right? Who's the new leadership? And you got to ask yourself that, right? And then we'll get into where other opportunities are outside of these sorts of companies. Well, the new leadership of this stock market, the new hope stocks, the new innovators, the super innovators, the growth companies are these two. One is NVIDIA, and it's pretty self-explanatory. NVIDIA's market cap's now over $2 trillion. If they blow it out of the water again next quarter, NVIDIA could climb to the biggest market capitalization in the world. It could pass up Apple and Microsoft. They got to come through with one more quarter of booming numbers, beats across the board, and another super strong guide, and you will see NVIDIA pass up Microsoft and pass up Apple for the biggest market capitalization in the world. It's already past Google McDougal at this point in time. NVIDIA represents hope. It represents growth. It represents true innovation. It represents really changing the game, right? And pushing boundaries that people weren't thought possible. That's NVIDIA. And the other super innovator that's a big dog is Meta. You look at what they've done over the past few years with their Stories feature, Reels, the Threads product, all the innovation on the WhatsApp side for the business side, AI for video and ad recommendations, It's clear as day. In the numbers, look at the growth rates of a Meta versus the growth rates of a Google or the growth rates of an Apple or lack of growth rates of those sorts of companies. It's a night and day difference, right? And so a company like a Meta is now seen as, wow, they're actually a super innovator. They actually changed the game. They actually represent hope and change for the future, right? Versus Apple and Google that are just kind of stuck in place. And so, you guys ever seen this movie, the Captain Phillips movie? There's that great scene. It says, look at me. Look at me. I'm the captain now. And that's NVIDIA and Meta. And Apple and Google just kind of standing there, and they're just, they're bigger market caps than NVIDIA and Meta right now. Well, Google just got passed by NVIDIA. I wouldn't be surprised if Meta actually ends up passing up Google in the next year in terms of a bigger market cap than Google. And like I said, NVIDIA could take down everybody in the next 9 to 12 months if they just come through and knock it out of the ballpark again. So this is a situation in the market. You got to understand you've got to invest a little differently in that sort of market, right? And to illustrate this point a little deeper, in 2022, in the NASDAQ crash, right? The NASDAQ fell 35% plus peak to trough in terms of where it peaked in Q4 of 2021 versus the lows in 2022 in the fourth quarter, right? And you look at Apple and Google, those stocks held up decently well in that crash. Meanwhile, NVIDIA was down 50%. Meta was down 60+% in that crash. So you can see in a scary market, people gravitate toward an Apple and Google because they're seen as more like needs-based, which once again puts them more into a category of a Walmart. By the way, Walmart's got way better growth than Google and Apple. You check out Walmart's latest growth rates. I mean, you would think they're the super innovator. It's ridiculous. But ExxonMobil, Chevron, these sorts of companies, that's the way an Apple Google scene. So if there's a big market crash, some people actually like to hide out money in some of those stocks, right? They're like, well, I'm scared about things, so let me just put my money in Apple stock for now. And that's the way a lot of people think. So the old days when you saw pull up the CNBC app or whatever you use to, just kind of check the market quickly, right? And you saw the Dow up, you saw S&P, you saw the NASDAQ up 1%. The old days you would say, oh, Apple and Google, man, they must be having a great day. It's changed now. If you see that, now you need to be thinking, oh, NVIDIA and Meta, they must be having a great day. It's a big change that's happened now at this point in time. NASDAQ's up 1%. Oh, how much is NVIDIA up? 3%, 4%, 5%? How much is Meta up? 2, 3, 4%? How much is Meta up, right? That's a thought process now at this point in time. Now, you got to also ask yourself, what are the super innovator companies? What do they all have in common versus the ones that are seen as kind of more oil and gas related stocks now, needs-based, right? Well, guess what? They all still have the CEOs in place that built these companies, right? Elon Musk at Tesla, which Tesla's been going through obviously tough times because they're in the automotive sector, and automotive sector is very cyclical. It's up and down, right? So they've been kind of going through tough times, but Tesla still looked at as a super innovator. They still are. That's why the stock always trades very rich forward P on that stock, and it always will. At least as long as Elon Musk is at the helm there at Tesla, Tesla's always going to trade at extremely rich forward Ps because it's a super innovator. The things that they're doing at Tesla, they're just not being done at other companies. You can't do those things. You can't pull that off. It's impossible unless you're Tesla, right? And that whole brain trust of SpaceX and what SpaceX has been able to pull off, which is another Elon Musk company. I mean, you can't replicate that in your dreams, maybe, right? And then you look at obviously Meta in Zuckerberg there, and he's able to say, we're going over here, we're doing this, and you're doing that. And no one else has that sort of pull. No one else has that sort of confidence to do what Zuckerberg did and said, we're going to cut a massive amount of our employees, and we're going to launch an X competitor, and we're going to do this, and we're going to do that. No, you just can't pull it off. Zuckerberg can. He owns so much of the company, and he's had so much success that he can do whatever he wants. Jensen over there at NVIDIA, he can do whatever he wants as well. He says, we're going here and we're going to focus on this. And, a lot of the success you see of NVIDIA and what they're having as success today, remember, this is projects that were started 5 and 10 years ago at NVIDIA. And so when Jensen had his team start to work on these sorts of projects that are really come to fruition nowadays, right? And you're seeing the proof in the pudding and why NVIDIA might climb the biggest market cap in the world. That man put all this in place when this wasn't even seen as like a potential. This is like 10 years ago. Excuse me. Remember, I'm not quite all better. that wasn't even like thought of as like a possibility, but yet he was able to do. He was able to put that R&D there and said, tough, I know you guys don't understand what I'm spending all this money on right now, but 5-10 years from now, you're going to understand it. And now people are looking and like, oh, dang, we really understand it now at this point in time, right? So that's some food for thought there. Now, keep in mind, in order to see opportunities for super innovators, tech companies, the hope of the future, right? You don't need to just look at the big dogs like the NVIDIAs, the Metas, the Teslas for innovation, those sorts of companies. There's other opportunities out in the market way underneath those sorts of layers of those massive companies there, okay? All right, let's get into some inflation numbers, then we'll get into these other videos.
All morning, we are just a few seconds away from some new PCE inflation data, personal income and spending numbers, and initial jobless claims. It's the PCE number that's the biggie, though. That's the one the market's waiting for because that's the one the Fed watches so closely. Ahead of that, we've been watching the futures, and the Dow has been in the red all morning long, along with the other major averages. Dow, right now, down by 140, NASDAQ off by 44, the S&P off by 14. Rick Santelli is standing by at the CME in Chicago. Rick, take it away.
Yes, well, jobless claims, 215,000, higher than expected. 215,000 is the loftiest level going back to the beginning of February. On continuing claims, 1,905,000, and we finally crossed over 1.9 million. That's the highest read since the third week in November. Now the money numbers, personal income for January, up 1%, up 1%. And you know what's fascinating here? Last January, guess what? We started out up 1%. And last January, that was the highest level going all the way back to July of 21. So we're equaling January. This number, once again, could take you back to July of 21. That is a whopper of a spending jump, or income jump, excuse me. On spending, up 0.2, exactly as expected. Real spending goes negative when adjusted for inflation. That's down 0.1%, and down 0.1% equals what we had in August of last year. To find a lower number, you have to go to March of 2023. Now, let's get into it. The deflator, personal consumption deflator, month over month, up 0.3%, exactly as expected. In the rearview mirror, 0.2 becomes 0.1. Now, on the 310 side, that's the highest level since September of last year, something to pay attention to. Now, let's go back to the deflator, but this time the core, okay? And let's go, let's go year over year on the deflator, and that's going to be up 2.4%, exactly as expected. 2.6 in the rearview mirror, so making very good progress. This is the lowest level since February of 21. Now, month over month, core deflator up 0.4%, exactly as expected. And 0.4%, though, follows up 0.1%. So up 0.4% is the warmest number going all the way back to January of last year. If you round it to half, if you round it to 0.36 up to 4%, that would be February of last year, because we take these things out a couple of digits. And finally, year over year core deflator, in my opinion, one of the more important numbers, 2.8. Last, what we expected, 2.9 last time, so we've made progress. Now, here's something interesting. This is my favorite calculation. This is now the 12th consecutive month that this has moved lower than the previous month, and that is indeed a very good thing, of course. Now, 2.8% is good, but consider this. Pre-COVID in March of 2020, this was 1.5%, just to give some context. Now, what have yields done? They've dropped precipitously here from basically 430 all the way down to 427. No, I'm being a bit facetious. We dropped 3 basis points, but it is something to consider why we've dropped 3 basis points. And I think the real spending numbers being on the weak side might have contributed to that. We see that the pre-opening equities, the Dow Jones, has indeed moved up. And that's something to pay attention to here as well. It's getting close to, at least on the future side, positive territory. Now, I know that was a lot, Becky, but we want to take it step by step because these numbers are that important.
Yeah, so, I mean, everything's going kind of the way you'd want to see it. I'll just put it like that for now. It doesn't mean it's going to stay like that 6 months. The bottom line is there's still inflation in the system. It is obviously at a much lesser extent than we've seen it at, right? Real wages are getting in a pretty good place, which is very exciting for this year at least. And so, if you look at the trueflation numbers, we're under 2% CPI right now. So I think everything's going the way we want it to go. Let's just put it like that. Okay.